Happy New Year! We're officially in the year of 2023. In this video, I'm going to share with you what's the local real estate experts' prediction of 2023 housing market in Orange County. Coming up! Before we look at the 2023 forecast, we should take a look back at 2022 to see that what's the inventory level, buyer's demand, luxury market, and expected market time. This 2023 forecast is provided by our local real estate economist, Stephen Thomas. Stephen is the local real OC resident, and also he's been following the market for decades. And the forecast is dated December 27, 2022. Let's start with the listing inventory in the past few years. Here we'll see 4 color lines. Just want to give you some high level so you can follow what the data, to read the chart. So the purple line is 2019, that's pre-COVID time, followed by the green line, that's 2020, and the red line is 2021, and the orange one is the year we just sent away, 2022. So at the beginning of 2022, we start off the inventory of only like below 1,000 homes. It's only 954 homes. That's the lowest level since 2004. And over the month, we see the inventory start to pick up. Specifically in May, we see like a steeper pick up. That's when the inventory hits 5%, and in June it hit 6%. Just to put things into perspective, at beginning of 2022 we start up like 325 and get to 5 in May, and June in 6%. In December 2022, the total inventory level, yes, you definitely compare to the beginning of the year, we see is picking up. But we closed that year at 2,642 homes. Just put things into perspective, it's still way lower than 2020 during COVID time and lower than pre-COVID time, 2019. Next, we're looking at the buyer demand. So after 2 years of a heightened demand due to the historical low mortgage rates, demand actually fell to its lowest level since the Great Recession. Let's look at the orange line. See, at the beginning of the year, it's at around 1,408 homes pending sales, and demand has peaked at the very end of March at about 2,286 homes. And if we compare the orange in March to the yellow line, the red line, that's the 2021. That's the demand of 28% lower than the same period last year. And even we compare that number, the orange, to a 3-year average, that's pre-COVID number, that's slow, still 19% lower. So it's a super low level, it's low compared to 2022, same period last year. So look at the March peak. That's 28% lower than the red line. That's just the same period last year. Like the 2021 March, that's a 28% lower than 2022. And even we compare that number to a 3-year pre-COVID average, that's 19% lower. And this lower demand is impacted by the skyrocketing mortgage rate. Let's just put things into perspective. Let's say we're buying a home with a $900,000 loan amount, and with a 3.25%, that's the beginning of the year, January rate, the home buyer will expect it, the home loan payment to be about $30,917. So it's $3,917, the monthly payment. But once the rate hits 6.25, that'll require additional $1,600. So definitely the affordability is getting like more challenging for home buyer. And if we look at when the rate further jump up over 7, let's just take 7.35% example for the same $900,000 loan amount, the monthly payment will be an additional $2,284. So that's why all been contributing, like putting pressure on the buyer activity, why we see such a weakening buyer demand. Even when the rate come down a little bit from the high of 7.25, we see that come back down towards 6% in December, but the demand remain muted. Now we see that the inventory are low, buyer demands are low. I think this is a very interesting chart I want to share with you. So here is the lighter blue is the active listing, and the darker blue is the demand. So there's a ratio between the supply and demand, or the seller's listing versus the buyer's activity. So here we do see that the darker the demand is going down, inventory is going down, but the delta between the gap between how many demand, like low demand, low supply, but what's the surplus inventory available? There's definitely nowhere compared to here. That's when during the 2007, 2008. And remember, this is the Orange County specific chart. We're not looking at a national level. Just want to put things into perspective. Yes, the demand is going down. It's getting slow. Market is slower, but just look at it. We're not in the place like the last crash when there are 16,000 inventory. Like here right now, we're right below 4,000 inventory. Just want to share with you because I know I work with a lot of buyers. A lot of buyers feel like, oh, market's gonna crash, I'm gonna wait. Or even when we're writing offer, we're trying to get like a huge discount, but it's just not the same market. Now we're looking at the luxury market. So in Orange County, the definition for a luxury market is for those homes above $2 million. So the luxury home market was at a record pace, but fell short by 11% through November as luxury slowed substantially to wrap up the year. As you can see, the orange line here is trending down. They pretty much, the demand at highest around the March, April time, but ever since it's kind of coming down. The last metrics we'll be looking at before we get into the 2022 forecast is the expected market time. So that's the amount of time that it took to place a home listed today into a escrow down the road. So it's based on the current supply and demand dynamic. So we start the year with an extremely low number. Look at the orange line here at the beginning in January. It's only 25 days. But as the mortgage rate continue to pick up, we see that the days continue to get longer. So around in the May time, it hits 40 days. Mid-May hits 40 days and continue the trend in mid-July to 70 days. And then it kind of retreated slightly in August following the when the rate kind of dropped back. Then it pick it up again around October, November time. And by the end of year, like December, it's in the 7-ish average expected market times again. Here's Stephen Thomas' forecast for 2023. He thinks it's gonna be a subdued year for housing. In terms of inventory level, he believes this year will begin with below 2,500 homes. If you remember a number like December, we had 26 and 42 homes. He believed at the beginning of the year, it will be even lower than that number. And that'll be the second lowest year since 2004, only behind the beginning of 2022. And Stephen believed the inventory crisis will continue and expect the inventory level to rise on the back of diminished demand, only to be hampered by the hunkering down effect. That's when all the homeowners, they choose to stay in their home because their underlying low mortgage rate. And he thinks that more home probably will join the market when the mortgage rates start to hit below 5.5%, which is expected to be around mid-2023. With that, the forecast in terms of the peak inventory will be around 5,500 homes around August time. In terms of demand, because of the persistent high mortgage rates, and the buyer demand probably will continue to be muted. And with less competition and pressure on affordability, Stephen thinks that buyers will be extremely cautious and they're not willing to stretch to make any above list price offer. They'll be looking very carefully at the price. So his expectation is home value potentially could drop between 6 to 8% for the year. And there's a strong potential the mortgage rate probably will dip below 5.5% by summer due to the combination of the slower economy and the falling inflation. While with the low rate, demand will strengthen along with affordability. So the combination of low rates and low home price will prompt the rise in pending sales activity. What about housing cycle? Well, the housing market probably most likely will follow a normal housing cycle, the seasonality. So the strongest demand coupled with the highest level of new seller, will occur during the spring market. And then it'll be followed by a slightly less demand and a continued new supply of homes in summer. From there, the demand will drop further, along with fewer home entering the market this autumn market. Finally, with all the distraction of the holiday market, that'll give us the lowest demand for the year and fewer homeowners opting to sell. So winter market will be the slowest one. In terms of closed sales, Stephen's prediction is that the closed sales will decrease also between 6 to 8% compared to 2022. That'll bring us to around 22,900 homes in Orange County. In terms of the luxury market, the spring market will be the strongest one for the luxury market and will become a bit more sluggish to the stock market volatility and during the second half of the year. In terms of interest rates, Stephen thinks that the mortgage rate will start around 6.5% and slowly it'll drop as the economy slows and inflation kind of gradually eases. The rate expected to fall below 5.5% around summertime, or even fall below 5% by year's end. The bottom line, 2023 will continue where housing in 2022 left off, extremely sluggish. Housing is particularly interest rate sensitive, and the value will drop due to severe affordability issues. The value will only stop retreating when mortgage rate drop below 5.5%. According to Stephen, the housing market is no longer insane. Homes are, for the most part, not selling above their asking price, not selling immediately, not selling with multiple offers. And there's far more activity and buyer competition. That's 2023 housing forecast by Stephen Thomas, dated December 27. As the market continues to evolve, I will continue to bring you up to date what's the latest expert's opinion. If you want to know specific your home value or the market situation in your community, give me a call, shoot me a text. I would love to break it down for you.